There's a pattern in history that has destroyed investor wealth 4 times in the last 300 years. The South Sea Bubble of 1720, the Railway Mania of the 1840s, the dot-com crash of 2000, and right now, in 2025, the AI boom is following that exact same pattern, stage by stage, warning sign by warning sign, almost like we're reading from a script written in blood and bankruptcy filings. In the last 24 months, $1.5 trillion has been poured into artificial intelligence infrastructure. Nvidia became the first company in human history to reach a $5 trillion valuation. OpenAI, a company that lost $5 billion last year, is now valued at $500 billion, tripling its valuation in just 12 months. And the Magnifcent 7 tech stocks now make up 33% of the entire S&P 500, higher than the concentration at the peak of the dot-com bubble. But here's the paradox that should terrify you. 95% of companies deploying AI have generated zero measurable return on their investment. Not negative returns, not disappointing returns. Zero. According to MIT research, the vast majority of AI projects are complete failures. Yet companies are spending $320 billion this year alone on AI infrastructure, and they're planning to spend $500 billion next year. This is the largest speculative bubble in financial history, and the math says it's going to burst. In this documentary, I'm going to show you the exact 5-stage pattern that every technology bubble follows. I'll show you how the South Sea Bubble, Railway Mania, and dot-com crash all followed identical sequences, and how AI is replicating that sequence right now. I'll show you the specific warning signs that preceded every crash, why 2026 is the danger zone, who will be destroyed, who will profit, and exactly what signals to watch for so you can position before the collapse. Because this isn't speculation, this is pattern recognition, and the pattern has never been wrong. Before I show you the historical pattern, you need to understand what a technology bubble actually is, and why they're so devastating. A technology bubble is not just stocks going up too fast. Plenty of stocks rise quickly without being bubbles. A bubble is something specific. It's when the narrative about a technology detaches from the economics of that technology. Here's what I mean. Every bubble in modern history has been based on a narrative, a story about unlimited future growth that makes current valuations seem reasonable. In 1720, the narrative was that South American trade would generate infinite riches. In the 1840s, the narrative was that railways would transform every industry forever. In 2000, the narrative was that the internet would eliminate all traditional business. And right now, the narrative is that AI will automate everything, replace every worker, and generate unlimited productivity gains across every sector of the economy. The narrative isn't necessarily wrong. The internet did transform business, just not in the time frame or way that investors in 2000 imagined. Railways did revolutionize commerce, just not fast enough to justify the valuations of 1845. And here's the critical insight that nobody talks about. The technology was real. The transformative potential was real, and the bubble still burst. Being right about the technology doesn't protect you from the bubble dynamics. The data proves this conclusively. In every historical bubble, the underlying technology succeeded, often spectacularly. But the investors who bought at the peak lost 95% of their money, even as the technology they bet on changed the world. This is the trap. This is why smart people get destroyed. They're right about the technology and wrong about the timing. And being right about the technology makes them confident, which makes them stay invested too long, which makes them lose everything. Let me show you exactly how this pattern has played out 4 times, and why AI is different only in the scale of the coming destruction. Let's start with the original technology bubble, London, 1720. The South Sea Company was formed in 1711 with a brilliant premise. Take over $9 million of British government debt in exchange for monopoly trading rights in South America. The Spanish colonies were legendary for gold and silver. British merchants imagined fortunes from the New World trade. In January 1720, South Sea Company shares traded at 128. By August, they hit $1,000. a 680% gain in 8 months. That's the equivalent of a stock going from $100 to $780 in less than a year, and everyone in British society was buying. Isaac Newton, the greatest scientific mind of his era, invested heavily. Duchesses, merchants, and clergymen all piled in. The company's value exceeded Britain's entire annual GDP. But here's what nobody understood. The company had almost no actual trade with South America. Spain had granted Britain exactly 1 ship per year, a single vessel, to trade in the colonies. The monopoly was essentially worthless. The entire valuation was based on a narrative, not economics. Stage 1 of every bubble. A revolutionary narrative captures public imagination. The narrative has elements of truth. South American gold was real, but the connection between the narrative and the company's actual business is tenuous at best. Stage 2. Easy credit amplifies speculation. The South Sea Company lent investors money to buy its own stock. You could borrow from the company to buy shares in the company. This created artificial demand that pushed prices higher, which created more borrowing, which pushed prices higher still. Sound familiar? Right now, Nvidia is extending credit to AI companies so they can buy Nvidia chips. OpenAI, which loses $5 billion per year, is valued at $500 billion based on future growth projections. The circular financing structures are identical. Stage 3. Skeptics are silenced by price action. In early 1720, some voices warned that South Sea Company shares were overvalued. They were ridiculed. The stock kept rising. By summer even, the skeptics had either shut up or bought in. Isaac Newton himself sold his shares in April 1720 for a 100% profit, and then watched the price double again. Unable to resist, he bought back in near the peak. He eventually lost 20 koh-i-noors, the equivalent of $268 million today. Newton famously said, "I can calculate the movement of the stars, but not the madness of men." Stage 4. The trigger event. In August 1720, directors started secretly selling their shares. Word leaked. Confidence cracked. By September, the stock had fallen to $150. By December, $124. The collapse took 4 months. 80% of the value evaporated. Banks failed. Investors were ruined. Suicides increased. Parliament launched an investigation and found widespread fraud. Stage 5. Long-term consequences. The British government passed the Bubble Act, restricting joint stock companies. Economic historians argue the crash delayed the Industrial Revolution by decades, as capital became scarce and investors became risk-averse. The lesson of the South Sea Bubble. A real opportunity can generate a fake bubble. South American trade existed. Gold was real, but the connection between the narrative and the economics was a fantasy, and everyone who bought the fantasy lost everything. Now, let's jump forward 125 years. Britain, 1845. The railway was the AI of its era, a transformative technology that would reshape civilization. And unlike South Sea trade, the railways were real. By the early 1840s, successful railway lines were generating 10% annual returns, spectacular profits in an era when government bonds paid 3%. The success of early railways triggered a frenzy. Between 1844 and 1847, Parliament authorized 8,000 miles of new railway construction. Investors poured capital into railway shares. By 1846, railway investment equaled 7% of Britain's entire GDP, an astonishing concentration. Here's the pattern repeating. Stage 1, revolutionary narrative. Railways would connect every city, transform commerce, eliminate geographical barriers. The narrative was correct. Railways did reshape the world. Stage 2, easy credit. The Bank of England had lowered interest rates to revive the economy. Cheap money flooded into railway shares. Investors borrowed to buy. Promoters raised capital for routes that made no economic sense. 1/3 of the railway lines authorized by Parliament were never built. Some routes were transparent frauds. Others were simply unprofitable, but as long as share prices rose, nobody cared. Stage 3. Skeptics silenced. Even the most respected critics were ignored. The price kept rising. Profits from early railways seemed to validate the entire sector. Why question success? Here's what the promoters hid. Railway companies were manipulating their accounts. They were understating depreciation, overstating profits, and paying dividends from capital rather than income. The accounting fraud was systemic. Directors knew the real numbers. Investors saw fantasy projections. This is where the AI parallel gets uncomfortable. OpenAI claims it will hit $13 billion in annual revenue, but leaked internal documents suggest actual revenue is closer to $4 or $5 billion. The gap between narrative and reality is widening. Stage 4. The trigger. In 1845, the Bank of England raised interest rates to control inflation. Suddenly, borrowing was expensive. Railway shares started falling. Investors who had bought on credit faced margin calls. Forced selling accelerated the collapse. By 1848, railway shares had fallen 40%. Many initial investors lost everything. The crash triggered the October Panic. 4 banks failed. The entire financial system nearly melted down. Stage 5. Long-term consequences. Surviving railway companies consolidated. The speculative excess was eliminated. But it took 20 years for railway shares to recover to their 1846 peaks, even as the actual railway industry expanded enormously. The lesson of railway mania: the technology can succeed while investors fail. Railways transformed Britain. They were the right bet. But investors who bought at the peak in 1845 lost decades of wealth, even as the industry they invested in revolutionized the world. And this is the cruelest irony of technology bubbles. Being right about the technology doesn't protect you. Now let's look at the most recent and most relevant example. America, 1999. The internet was going to change everything, and unlike South Sea trade fantasies, this was obviously true. By the late 1990s, email, e-commerce, and online media were already transforming how people lived and worked. The Nasdaq index rose 86% in 1999 alone. It peaked at 5,048 on March 10, 2000. The total market value of dot-com companies exceeded $6 trillion, much of it in companies that had never made a penny in profit. Pets.com raised $82.5 million in its IPO and collapsed within 268 days. Webvan raised $800 million to deliver groceries and went bankrupt. Hundreds of companies followed the same arc: massive funding, explosive growth, complete collapse. But here's what most people get wrong about the dot-com crash. The companies that failed weren't random. They followed a specific pattern. Stage 1. Revolutionary narrative. The internet changes everything. This was true, but it was used to justify any business model, no matter how ridiculous. Stage 2. Easy credit. The Federal Reserve had lowered interest rates after the 1998 LTCM crisis. Venture capital flooded into internet companies. Companies that would never be profitable were valued at billions. Cisco Systems, the picks and shovels of the internet infrastructure build-out, reached a $500 billion market cap with a price-to-earnings ratio of 196. That means investors were paying $196 for every $1 of current earnings, betting that growth would continue forever. Stage 3. Skeptics silenced. Anyone who questioned valuations was called old economy thinking. Price action seemed to prove the bulls right. Every correction was a buying opportunity. Stage 4. The trigger. In early 2000, the Federal Reserve raised interest rates to control inflation. Combined with a global economic slowdown starting in Japan, investor confidence cracked. Between March 2000 and October 2002, the Nasdaq fell 77%. $5 trillion in market value evaporated. Over 4,800 internet companies either shut down or were acquired for pennies. Cisco fell 89% and still hasn't recovered in inflation-adjusted terms, 25 years later. Microsoft took 17 years to return to its 2000 peak. Even Amazon, the ultimate dot-com winner, fell 94% before recovering. Stage 5. Long-term transformation. The internet did change everything. Amazon, Google, and Facebook, companies that barely existed in 2000, became the most valuable companies on Earth. But investors who bought at the peak in 2000 lost a generation of wealth. The lesson of the dot-com crash. The bigger the narrative, the bigger the bubble. The internet changes everything was completely true, and it still generated the largest market crash since 1929. Now here's where it gets truly insane. Every warning sign that preceded the South Sea bubble, railway mania, and dot-com crash is present in the AI market right now. Not some of them, all of them. And in many cases, the metrics are worse than at previous peaks. Let me show you exactly where we are in the pattern. Stage 1, revolutionary narrative. AI will automate everything and transform every industry. This narrative is being pushed by every tech company, every financial analyst, every media outlet. And just like previous narratives, it contains elements of truth. But it's being used to justify valuations that have no connection to current economics. Sam Altman, the CEO of OpenAI, publicly admitted, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes." When the person running the most hyped AI company says the market is overexcited, pay attention. Stage 2, easy credit and circular financing. This is where the AI bubble gets dangerous. Nvidia, the dominant AI chip company, has extended credit and taken stakes in AI companies so they can afford to buy Nvidia chips. This is exactly the circular financing structure that inflated the dot-com bubble and the South Sea bubble before it. OpenAI is reportedly spending $8.7 billion per year just on Microsoft Azure compute costs. That's more than double what they spent in 2024. Their projected losses are $509 billion annually. Yet, they're valued at $500 billion. The Magnificent 7 tech stocks, Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla, now represent 33% of the S&P 500. This concentration is higher than at the peak of the dot-com bubble, when the top NASDAQ stocks represented 25 to 30%. Bank of England regulators warned that AI company valuations could collapse if infrastructure requirements are too high to meet, and that investors are not properly cautioned about the risks. Goldman Sachs strategists wrote, "We see a growing risk that the imbalances that built up in the 1990s will become more visible as the AI investment boom extends." Stage 3, skeptics silenced. Every AI skeptic is dismissed as missing the revolution. When Jim Chanos or other short sellers question AI valuations, they're called dinosaurs who don't understand the technology. But here's the data nobody wants to talk about. MIT research found that 95% of businesses deploying AI have generated zero measurable value from their implementations. Not disappointing value, not break-even. Zero. Deloitte's 2025 survey of 1,054 executives found that only 10% of organizations are realizing significant ROI from AI. The other 90% are either losing money or waiting years for returns that may never come. The narrative says AI is transforming business. The data says 95% of AI deployments are failures. Which one do you think the stock market is pricing? Now let me show you the mathematical inevitability of this bubble bursting. The AI infrastructure build-out requires unprecedented capital expenditure. Amazon, Microsoft, Google, and Meta are spending $320 billion this year on AI data centers and chips. That's expected to exceed $500 billion by 2026. Global data center power demand is projected to consume 4% of all electricity by 2035. If data centers were a country, they would rank fourth in electricity usage, behind only China, the United States, and India. The AI boom is causing electricity prices to surge 267% in areas near data centers. Utilities are struggling to keep up. Infrastructure constraints are real, but here's the devastating math. For AI investments to justify current valuations, the industry needs to generate trillions in new revenue, not billions. Trillions. Goldman Sachs analysis estimates that $2 trillion in AI-generated revenue must materialize by 2030 just to justify current infrastructure spending. Current AI revenue across the entire industry? Maybe $50, $100 billion annually, most of it concentrated in Nvidia chip sales. The gap between what must happen and what's actually happening is 20 times. That's not a slight overvaluation. That's a bubble of historic proportions, and the companies at the center of this bubble are showing strain. OpenAI, $5 billion in annual losses on $10 billion in revenue, burning cash faster than they can raise it. Meta, spending $72 billion on AI infrastructure, while their Reality Labs division loses $4.4 billion per quarter. Microsoft reported a $3.1 billion decline in net income last quarter due to OpenAI investment losses. Ray Dalio, the founder of the world's largest hedge fund, warned in November 2025, "There is definitely a bubble in markets." He said current conditions are approximately 80% of the way to historic bubble peaks, and warned that margin debt at a record $1.2 trillion could trigger cascade selling. When the founder of Bridgewater Associates says we're in a bubble, that's not speculation. That's pattern recognition from someone who's seen every market cycle of the last 50 years. So, when does this bubble burst? Based on the historical pattern, bubbles pop when one of three triggers hits: interest rate increases, a major financial scandal, or a shift in investor psychology. The dot-com bubble burst 1 month after the Federal Reserve raised interest rates in early 2000. Railway mania collapsed after the Bank of England tightened credit in 1845. The South Sea bubble popped when insiders started selling and confidence cracked. All three triggers are present right now. Trigger 1. Interest rates. The Federal Reserve has kept rates elevated to control inflation. If rates rise further, or if they stay high while the economy weakens, speculative investments like AI stocks face maximum pressure. Trigger 2. Financial scandals. The accounting at AI companies is increasingly questionable. OpenAI's revenue claims don't match leaked internal documents. Circular financing between Nvidia and AI startups echoes the vendor financing scandals of the dot-com era. Trigger 3. Investor psychology. Hedge funds are already de-risking. In the week of April 21, 2025, Morgan Stanley reported that 60% of every dollar sold by hedge funds globally was in Magnifcent 7 stocks. The smart money is quietly exiting. The average lag between peak insider selling and market crash in previous bubbles was 6 to 18 months. Peak AI hype occurred in mid-2024 to early 2025. That puts the danger zone in late 2025 through mid-2026. Goldman Sachs warned that the AI trade now looks the way tech stocks did in 1997, several years before the bubble burst in 2000. If that timeline holds, we have 2 to 3 years of remaining mania before collapse, but bubbles can accelerate. The South Sea bubble went from peak to crisis in 4 months. The dot-com crash took 30 months from peak to bottom. AI could follow either timeline or something faster given algorithmic trading and interconnected markets. The consensus from institutional analysis: 2026 is the most dangerous year. That's when infrastructure spending reaches maximum, returns remain elusive, and the gap between narrative and reality becomes undeniable. Now let me show you who wins and who loses when this bubble bursts. Who wins? Short sellers and put option holders. Those betting against overvalued AI stocks will generate spectacular returns. The dot-com crash created billionaires from short positions. This crash will too. Cash holders. When the bubble pops, everything goes on sale. Quality companies that fall 50-70% become generational buying opportunities. Investors who held cash through 2000 and 2002 bought Amazon at $6 and made 50,000% over the next 20 years. Infrastructure providers with real revenue, companies selling actual products, not narratives, survive bubbles. The picks and shovels plays that generate real cash flow will emerge stronger from the wreckage. If you understand this pattern, you can position now. Reduce exposure to the most speculative AI names. Build cash reserves for post-crash opportunities. Consider hedges through put options or inverse ETFs. WHO loses. Retail investors in AI stocks. The average investor who bought Nvidia at $180 or Palantir at 700x earnings will suffer devastating losses. In the dot-com crash, the median tech stock fell 80%. Many went to zero. Your $100,000 portfolio concentrated in AI stocks could become $20,000, $30,000 within 18 months. That's not pessimism. That's the mathematical average of previous bubble collapses. 401k. Investors who don't know their exposure. If you own an S&P 500 index fund, 33% of your money is in the Magnifcent 7. When those stocks crash, your diversified portfolio crashes with them. Workers at AI startups. Thousands of AI companies are surviving on venture capital. When funding dries up, layoffs will be massive. The dot-com crash eliminated over 4,800 companies. The AI crash could eliminate more. The window for avoiding this is narrowing. Every month that passes, more capital is deployed into overvalued positions. Every month, the eventual crash becomes more severe. Based on the historical pattern, here are the specific signals that will indicate the bubble is bursting. Signal 1. A major AI company announces more spending and its stock falls. In bubble dynamics, more investment is supposed to mean more growth. When investors reject that narrative, when Meta announces $80 billion in capex and the stock drops 15%, that's the psychology shifting. Signal 2. Insider selling accelerates. Corporate executives have better information than you. When they start selling in size, follow their lead. Track SEC filings for unusual sales patterns. Signal 3. AI company accounting scandals. Every bubble ends with revelations of fraud. Enron and WorldCom in the dot-com era. Expect similar scandals to emerge from AI companies. Signal 4. Interest rate spikes or credit tightening. When borrowing becomes expensive, speculative investments dive first. Watch the Federal Reserve closely. Signal 5. Major AI project cancellations. When corporations start canceling AI initiatives because ROI never materialized, the narrative cracks. This is already happening quietly. 95% of AI projects failing means cancellations are coming. When you see 2 or 3 of these signals simultaneously, the crash is likely imminent. Position accordingly. 4 times in the last 300 years, revolutionary technologies have generated speculative bubbles of historic proportions. The South Sea bubble, railway mania, the dot-com crash, and now the AI bubble. Every time, the pattern was identical. A real technology with real potential. A narrative that captured public imagination. Easy credit that inflated valuations, skeptics silenced by price action, and then, inevitably, a trigger that cracked confidence and sent prices crashing 70–90%. The AI bubble is following this pattern with mathematical precision. The Magnifcent 7 concentration exceeds dot-com peaks. The circular financing mirrors the South Sea scheme. The accounting manipulation echoes railway mania. And the gap between AI narrative and AI reality, with 95% of deployments generating zero value, is the largest disconnect in modern financial history. But here's what almost nobody understands. The technology winning and investors losing are not contradictory outcomes. They've happened together 4 times already. AI will transform the world. That's probably true. And investors who buy at these valuations will still lose 70–90% of their money. That's probably true too, because bubbles don't burst because the technology fails. Bubbles burst because the economics never match the narrative, and eventually reality asserts itself. The timeline says 2026 is the danger zone. The signals are emerging now. The smart money is already positioning. Here's what you need to remember. 1. History has never produced a technology bubble that didn't burst, not once in 300 years. 2. The technology succeeding doesn't prevent the bubble from bursting. Railways, the internet, and AI can all be transformative, and investors can still lose everything. 3. The warning signs are visible now. Concentration, circular financing, accounting manipulation, insider selling, all the elements are in place. The only question is whether you'll recognize the pattern before it completes, or whether you'll be holding overvalued AI stocks when the reset comes. If this changed how you see the AI boom, if you understand now that being right about the technology doesn't protect you from the bubble dynamics, subscribe to this channel, because I'll be tracking these 5 warning signals in real time. When 2 or 3 hit simultaneously, I'll show you exactly what's happening and why. The answers aren't hiding in Wall Street research reports or CNBC segments. They're written in 300 years of financial history, and that history is about to repeat.